The current equity market has continued to rally. Let's get some further detail and analysis. Robert Talevski joins us from Activum now to discuss just how sustainable that rally is. Great to catch up with you again, Robert. All right, well, we've just been discussing obviously what we're seeing in the States at the moment with, well, essentially it's all about NVIDIA driving the market broadly higher. I mean, how sustainable is that, do you think?
Yeah, look, thanks for having me. Look, it's a pretty positive environment for equities markets at the moment. Obviously, US data continues to be favourable. We're making quite a bit of progress on the CPI front. The US Atlanta GDP trackers looking very solid. Unemployment rates are still very low. You'd expect, given that sort of broader factors doing well, you would expect that to sort of translate that to the markets, but unfortunately not. That hasn't been the case. There's a real gap between sort of winners and losers. You've got Mag 7 up here, you've got the tech sectors, then the FANGs, and then the S&P. So quite a sort of a big gap between those sort of factors. And also, the percentage of S&P stocks above their sort of 50-day average has dipped to under 50%, also suggesting a bit of an uneven market from that perspective. However, look, we expect to see a broadening out of that rally as we see more earnings come through in this next quarterly earnings season. Markets have been very macro dependent, but we are also seeing a bit of acceleration in earnings growth data over the next 12 months as well. And in terms of sentiment, it's actually quite interesting that the bond asset classes have done exceptionally well from a flow perspective. Another sort of indication that maybe there's a lot of investors out there that have been quite conservative, and interesting given obviously that sort of equity market price momentum that we've seen in the last sort of year or two.
So, of course, we are approaching the end of the financial year, and that's a great time to take stock of where your portfolio is sitting at the moment and perhaps look at some readjustment. What should we be cognizant of, do you think?
Yeah, look, I think if we go back to sort of what we're expecting from an earnings as financial year sort of comes to a close, I mean, our active and high growth has returned about 18% for the last, almost financial year. Our active and balanced fund has done around 14%. So a very, very strong financial year expected. And that's a great result for obviously rewarding investors who have remained invested in the market. Some of the biggest contributors, particularly international equities, that's done exceptionally well, up 20% financial year. So not investing in international equities would have caused a bit of pain. The mega caps as well done exceptionally well around that sort of AI semiconductors and NVIDIA as well. And surprisingly, the A-REITs asset class has done exceptionally well over this financial year as well.
All right, that's looking back. Looking forward though, Robert, which sectors of the market are you liking and which you're a little more wary of?
I mean, we've still kind of liked the small cap sectors. I think sort of last year, I think they particularly look attractive, and we have been allocating to those sectors. And although I think there's still a lot of the mega caps are doing exceptionally well, we see a little bit more value in those sectors, and they should. We expect to do that sort of, I guess, catch up rally going forward. But however, look, in times like this, I think it's really important to sort of stay a little bit cautious as well. Obviously, great environment for equity markets, but we're also looking at things that might sort of cause markets on the downside. Look, obviously, NVIDIA has been a very big contributor to markets. However, we might sort of, if there's anything that affects that one particular stock, obviously that could cause quite a bit of an impact across the market, particularly around if we see a little bit of selling from senior management there. That could obviously cause some issues for that stock and obviously the overall market, given the dependence on that particular stock.
Regionally, which markets are you preferring at the moment?
Look, I think international equities is doing particularly well. We still like that particular sector. The US, obviously, you're not going to find that AI sort of exposure like you obviously would in the US sector. So I think definitely we're favouring the US. I know obviously it's looking a bit fair value from that perspective. I mean, Europe's doing reasonably well, but obviously they're still having their own issues on the macro perspective. Look, Australia should do okay. However, I think in a relative sense, I think the US equity market should continue to do well.